Hello and welcome to Authors Unbound, a mini web series by the MyyTake group that seeks to connect authors to their intended readers. I'm Arpit Agarwal, and our guest today is Dr. Mukund Rajan with his third book, Outlast, How ESG Can Benefit Your Business. Dr. Rajan, for those who do not know him, is chairman of ECube Investment Advisors, a unique platform that aims to power ESG improvements across industry. Previously, in a 23-year career, Dr. Rajan was brand custodian, chief ethics officer, and chairman of the Tata Global Sustainability Council. Welcome, Dr. Rajan. It's a pleasure to have you.
Thank you so much, Arpit. Thank you so much for having me on your show. And I think it's a terrific idea. So good luck with this initiative. I hope many more authors in the sustainability and ESG space emerge in India. Thank you for doing this.
Dr. Rajan, let me start by asking you, why ESG? What did you experience that prompted you to write about corporate governance and ESG?
So this is a space, Arpit, that I've been sort of involved with for a long time. If you take the E of ESG, in fact, the subject of the environment was actually the subject of my doctoral dissertation going back almost 30 years. And my first book was actually Global Environmental Politics, and was probably the first book on the politics of climate change in the Indian context. So it's a subject I've been familiar with and very interested in. As you mentioned, in the Tatas, I chaired the Sustainability Council. And in the last, I guess, 5 to 6 years, there's been a lot more focus on ESG issues in the Tata Group as well. One of the sort of seminal points, I think, in the Tata journey in sustainability was when Norges Bank, a few years back, decided to pull their investments in Tata Power as part of a decarbonization of the portfolio strategy. And that really shook all of us at the Tata Group at that time. And it really made it very plain that ESG issues like climate change were now going to really influence business strategy in a very big way. So when I was leaving the Tatas in 2018, I really felt that the time had come and corporate India needed a lot more help and support in the ESG transition. And I think the two critical drivers we spotted at that time, one was, of course, climate change. The other was the concerns around corporate governance. I think with the institution of the Insolvency and Bankruptcy Code, the formation of the National Company Law Tribunal, you saw many more Indian companies that were really coming before the courts, being accused of very poor corporate governance and being accused in large measure of being responsible for the very high non-performing assets in the Indian banking system. And that's obviously a big part of the economic slowdown that you saw before COVID happened. So really one felt that the time had come when these issues would receive much more importance. And given the experience one had and the interest in the subject, it felt like the right time to really create this new vehicle, ECube, which would focus on ESG issues. And ECube itself, as the name suggests, is drawn from 3 E's: engage and empower for ESG. So try and support corporate India in that ESG transition. I think this is the decade when we're going to see huge transformation around ESG principles.
Dr. Rajan, you mentioned, and I will refer from the book on page 4, by identifying material ESG metrics and improving the performance on these, businesses can gain greater efficiency in the use of resources, a lower cost of operations, reduced risk, and therefore cheaper insurance premium, minimized regulatory and legal interventions, greater employee productivity, lower cost of borrowing, increased analyst coverage and investor interest, and greater prospects for valuation re-rating. Dr. Rajan, if all of this can actually be achieved by simply increasing ESG performance, why is there a certain hesitancy still? Why isn't industry rushing to improve that? Is it just ignorance? Are there operational challenges? Or is there a cost to it that CEOs might find difficult to get past their boards and shareholders?
I think it's a combination of all of that. And obviously the answers vary from company to company. I have a chapter in the book called Codifying Conduct, where I talk about the reasons why many companies don't follow through on the code of ethics that they adopt themselves. And I think the answers are similar. Why do codes fail? Why don't people do the right thing? Why aren't corporates behaving responsibly? I think it's a combination of all the things you touched upon. So first off, I think there may be a lack of awareness, lack of information, particularly on some of the challenges relating to the E of ESG, the environment. Perhaps people don't know which new technologies will allow them to overcome some of these issues. Perhaps they don't know how quickly these issues are changing in the environment around them. If you go back in time, look at the politics of ozone depletion, for instance. It took a long time to get countries together to accept what was causing ozone depletion, and then what actions were necessary, including the phase out of chlorofluorocarbons, and then what technologies would be the best to sort of displace chlorofluorocarbons or CFCs in things like refrigerants, aerosols, deodorants, and so on. So some of these issues require explanation and take time for absorption, adoption in the corporate sector. Another reason is simply ignorance and sometimes, unfortunately, incompetence. There may be management that haven't invested the time, aren't bothered by some of these changes. Some of it often has to do also with the time frame with which they look at issues. If you're not too concerned about the very long term or the medium term, just looking at a very short term, the next quarter perhaps, if you're a listed company, you just want to make sure you get the right numbers to put before analysts and investors, then perhaps you're not really thinking about the long-term future. And some of these issues take time to really demonstrate how critical they are for the success of companies. So you can tend to ignore it, a few quarters, nothing much is going to change. Your competition also may be similarly not doing very much, and you can get away with it. But suddenly you reach this tipping point when these issues become major crises. And then the ones who have not invested commensurately in R&D and innovation, have not started preparing themselves, are the ones that get caught out. So I think there's an issue to do with the time factor as well, whether you're focusing on the long term or you're much too focused on the short term. And then, of course, there are challenges around availability of capital, access to technology. Particularly in India, I think the smaller companies often suffer from these issues. You don't have easy access to capital, therefore making the investments, particularly if large capital investments are required to prepare for some of these transitions and changes. If you don't have easy access, then you tend not to make those investments until you're really pushed into a corner or something else has changed that facilitates the availability of capital. So these are all issues. The final point I'll make is, sensible people, reasonable people can still disagree. So you may have situations where, two companies very similarly placed, always committed to doing the right thing, but have very different strategies. So nothing is sort of identical in the corporate world. Many companies have different ways of delivering on their strategy. So companies, for good reason, may sort of follow different paths. Some of them may find that the path they followed sort of takes them longer, or in fact, they get caught out by competition, which moves much more swiftly. So I think for all of these reasons, you'll see that, many companies, even though it seems obvious, behave ethically, act responsibly, do the right thing, invest in your people, invest in R&D. It doesn't happen. How many decades have we been talking about the poor R&D spends of corporate India? And the fact is, even today, for the last 20 odd years, that number of around 0.7% of GDP as R&D spend hasn't really changed. And yet we know for a fact that this is a big part of the reason why Indian corporates tend to be relatively more uncompetitive in global markets. China spends 3 times what we do as a percentage of R&D to GDP. The United States, Japan, Germany, all the advanced economies also spend much more. We know the issues, but we aren't yet doing as much about it as we could. So I think there are issues. There are issues of mindset, issues of the sort of time horizon. And certainly there are issues of capability and competence also, which impact why companies don't do what seems to be obvious and straightforward.
Dr. Rajan, the larger Indian companies are obviously better prepared to embrace an ESG agenda, but the smaller ones, especially the startups and the MSMEs, won't they find it a bit of a struggle? What are your thoughts?
Absolutely. I think you've hit the nail on the head. And in fact, there's a little bit of a worry that in recent years, there has been this phenomenon of increasing concentration that is taking place across sectors in the Indian economy. It's not a phenomenon that's only restricted to India. You see it in parts of the Western world. If you look at the big tech players, for instance, in the United States, all the companies that now have trillion-dollar market cap, all of them are really dominating their spaces quite dramatically. In India, I think one of the contributing factors has also been the introduction of the goods and services tax, the creation of a national market, the formalization of the economy. As a result, you're seeing now companies that are better equipped to address some of the legal and regulatory requirements are doing better. And post demonetization, these companies have really picked up the pace. So there's already a phenomenon where small and medium enterprises are sort of getting a little bit left behind. But the worry is now in the context of these new challenges in this decade around sustainability, issues around climate change, issues around energy efficiency investments, these companies may not, A, have access to the best available technology, may not have access to the capital to make significant capital investment, to repurpose their plant lines, production lines, maybe even rejig the business models. Maybe one of the great examples of what's going to happen is look at the auto sector. The shift away from the internal combustion engine, from petrol and diesel vehicles to electric vehicles is going to require component manufacturers to also step up and start producing more for electric vehicles than they do for the IC engine powered vehicles. And there may not be scope for all of the current auto component players to actually play a part in the EV ecosystem, because EVs are going to require far fewer components. Automakers, the OEMs are already on a campaign to really streamline their vendor base. So you add that to what you're seeing with the new innovation that people need to keep pace with. You look at what's happening in terms of increasing concentration, and you really worry about what is going to happen in the decade ahead with the small and medium enterprise. So I think it's going to require a very well thought through plan of action on the part of the government, on the part of stakeholders, to figure out how do these smaller entities really survive. The other space that, particularly in the context of climate change and global warming, is going to be hugely hit is anything that's dramatically dependent on fossil fuel consumption. So think about the entire coal industry and the value chain that supports the coal industry, including mining, thermal power plants, and the like. A lot of them are also going to be in trouble fairly soon as people start cutting back on investments, as lenders start pulling back on their funding of these projects, and as indeed players in the space stop sort of growing and start diverting resources to other plays. You're going to see, I think, a significant shakeout that will take place in the Indian market. And that can be worrisome. I think right now it's not yet apparent, but the pain will start showing up fairly soon. And I think we need to be better prepared for it. Right now, you don't hear too many people talking about this challenge, but it will become a major issue for the Indian market.
Dr. Rajan, that's about all the time we have today. We will have to leave it there, I'm afraid. But before we call it a wrap, let me read out an excerpt from the book that really essentially encapsulates what this book is about. This is on page 43. In the 1970s, Milton Friedman had argued that the managers of firms are employees of the shareholders, and the social responsibility of businesses is to increase their profits. Social problems cannot be solved by corporations, and these must instead be the responsibility of the government. For 4 decades, the Business Roundtable endorsed this principle of shareholder primacy, arguing that corporations exist principally to serve shareholders. But in a shift in stance heralded in August 2019, the Roundtable announced a modern standard of corporate responsibility, advocating value creation for all stakeholders. Viewers, this book is already on the stands. Do grab a copy. Thank you, Dr. Rajan. It's been a real pleasure. Hope to see you again very soon.
Looking forward to it. Thank you so much for having me on your show. Thank you so much.
If you have liked this video, do remember to share and subscribe as well. Thank you and goodbye for now.